and welcome to Dave Dinkle's Weekly Insights webinar. Tonight we're going to be reviewing the HUD-1 closing statement. I'm going to try to demystify the closing and show you how to make additional money at closing. Now, as I've said more than a few times before, I'm not a realtor, a CPA, or an attorney. Always seek the advice of these professionals if you have legal or accounting questions. If I mention any of my students in this webinar, they're not to be considered as anything but exceptional and certainly not just average. These students attained exceptional results because they worked very hard and they used the material and the instructions that we gave them. Tonight's core topic is demystifying the HUD, as I mentioned. HUD stands for Housing and Urban Development. We will look at how a HUD works in detail as sort of a balance sheet and simplify it as much as possible. Now, I happen to have a HUD as an actual transaction I did the last couple days, so you can actually see what one looks like. This is a to B transaction on a short sale. Now, closings do not have to be done on a HUD statement unless there's a mortgage involved that's issued by a lender, a national lender or bank. Typically, in many parts of the country, especially in the west coast of Florida, simple cash closings with investors are done on a single letter-sized paper, and the buyer and the seller's cost or proceeds are single line items. Some time ago, it's probably been a few years ago, I was doing a transaction over the side of the coast, and I asked the closing agent to send me a copy of the HUD, and what I got was a single-page closing letter. So it doesn't matter, it's just standardized effectively. We use them because it standardizes what everyone's looking at, but there's by no means do they have to be done that way. Now, this is what the HUD statement looks like, and I'm sure that based on the definition of whatever screen you have, you can't see these numbers, but we're going to break them down into details, into finite details. For example, what we're going to do is look at, we're going to break this down into parts and go through each part of it. Now, generally speaking, this type of accounting is boring as all get out, but the reality is it is very simple if you get down into its smallest parts, and it also will make you money every time you go to closing. So I need you to go to closing as often as possible to make more and more money. So let's go on to look at the first part, the top of the HUD statement. What you see here is the type of loan, and this is a cash transaction. So frankly, none of these are marked. Typically, the closing agent has a file number. That's what this is. They'll have a loan number if there's a conventional mortgage. Here's the name of the buyer. Okay, now on a HUD statement, it's called the borrower. You'll never see the term buyer. And the seller, of course, is the seller. This is my company, and what they've done is put in the address actually of the property itself. Now, I'm going to talk about that in a second. This is the seller, and this is the company that did the closing for us. This is the property location. But if you're going to have the property location be your mailing address, and you're either going to flip the property or you're going to rent it, you're not going to get the mail for the property. So put in the correct mail address here. This is typically done for a homeowner that's buying the property, getting a mortgage, he's moving into the property. I don't want to ever say these are mistakes, they're just things you need to watch out for. So what I've done on these next parts of the HUD statement is broken it down into buyer and seller sides. On the left side of the HUD statement, of the balance sheet, it's always going to be the buyer or borrower, but it's really the buyer. On the right side, it's always going to be the seller. B in the alphabet comes before S, so you can always remember. You don't have to look at the top of the HUD statement each time, but I put it on here for you anyway. This is the first part of it. In this particular transaction, I paid $39,000 for a fourplex. This is a short sale, as I mentioned. The deductions, in this case, are for the closing cost. If you notice, it says from line 1400. You're going to see line 1400. And line 1400 is the summation of the charges for what the closing agent is going to charge me, plus the other things that you'll see, which are basically charges by the closing agent or charges for liens and code violations, whatever else comes up. We'll see what's on this one. Here's the seller's side. Remember, if I'm the buyer, I paid $39,000 for the property. Obviously, the seller has to get $39,000 also. But what I have to bring to closing is $39,000 plus my expenses from the other side. So to begin with, my initial thought is I'm going to have to bring in $39,846.24, whereas the seller is going to have a credit going into the expenses of $39,000. That's the $846. Now, That's coming from line 1400 on the second page. If you can't see these numbers on your screen because it's too small, the definition's not high enough, whatever, don't worry about it. I'm going to try and talk you through all of it. If they're prepaid expenses to the buyer or seller, they become a credit here, but you very seldom see that unless there's HOAs or some other things going on. So this is the second part of the HUD statement. This is very important. Here's the settlement charges. Well, let me go through this first. I made note of this for a very simple reason. This is the earnest money deposit. See how much the earnest money deposit is? If you can't see it, it's zero. When you guys start talking to me about, the agent says he wants $10,000 on a $20,000 property, they won't take less than 10%. There's my earnest money deposit in this particular transaction, zero. And the 00 you see is the principal amount of a new loan. This is a cash transaction. I'm a buyer. So let's go down the page here a little bit. The next number that comes up is a credit for the taxes accrued from January 1st of this year until the closing date. And the closing date is 10/8, a few days ago. Now let's flip over to the other side of the balance sheet for the seller side. And the settlement charges to the seller, again from line 1400 on the other page, second page, are $2,444.51. Now you remember that my charges were $800 and change. The charges I'm going to show you on the second page can be on either the buyer or seller side, and they can be balanced. There's no predetermined they have to be here. For example, oftentimes what I'll do is a final closing round of negotiations, so to speak, as I say to a seller, let me do this. I will pay all the closing costs. Now, what do all the closing costs look like? It sounds like I'm paying everything. Well, the one thing I don't pay, if I can get away with it, is the accrued taxes. And when the seller says to me, well, you said you'd pay everything, and I say to him, look, you've spent 10 months of the year in the property itself, or you've owned it 10 months. So they're really your responsibility. I'm taking care of the second page. And quite often on the second page where the seller's line items are, there's nothing on there. Now, this is a real good tool to use in negotiations with a seller, because typically the seller remembers when he bought the home and he got a mortgage, he had to bring money to closing. There was thousands and thousands of dollars in mortgage expenses and closing costs and everything else. As a cash buyer, our expenses are minimal. We can virtually set them. So here's what happens. Oh, I wanted to show you this also. This is the payoff of the first mortgage loan. This is what the lender's getting. This is a short sale, as I mentioned. So the seller in this case is the homeowner. It's not the bank. I had someone send me a little note and say that she had changed on the contract that we use. Well, actually, she put in a clause that said other parts of this contract, wherever the word seller is used, refers to the lender of the property. This was a short sale also, and the lender has nothing to do with selling the property. The lender can only okay a principal reduction so that the seller can then close the transaction at closing. If you notice, the payoff, if you can't read it, it's $34,442.95. In the arrow, you see what the final judgment amount was, $307,396. So you guys who talk about, well, I got a reduction of 50% off the amount due, I didn't figure out how much that is, but it looks like it's about an 85% reduction. Now, on the other side of the balance sheet over here, as the buyer, okay, I'm getting a credit for the accrued taxes from January 1st through October 8th, and the seller is giving me that credit. So for him it's a deduction, for me it's a credit. Now I'm going to show you exactly how that's calculated and why that's important, because that's a huge credit. In calculating accrued taxes, the seller of the property must pay, as I said, his fair share of taxes from the beginning of the year to the day of closing. Does he have to do that? No. There's no law that says you have to do anything in closing in a real estate transaction other than to do it legally. So you can put those charges on your side, his side, whatever it takes to get it closed. The buyer then gets a credit on the statement, on the HUD statement, which I just showed to you on the left-hand side. Now, in a double closing, the A to B, A being the original seller, whether it be a lender, a homeowner, or anyone else, that's A investor, so to speak. The B investor is us. We're the investors buying the property. And then when we resell it, we're B investor, it sells to an end buyer who is C. In a double closing, us as the investors on the B side, we get a credit from the seller, and we have to pay the end buyer. So that transaction, if it takes place the same day, is what I call a neutral transaction. I don't know what it really is called, but that's what I call it, because you wind up paying no additional funds. However, If you carry the property for a few days, you wind up paying the carrying cost. Here's an example. Taxes are $2,500 for the year and the closing date's on the 180th day of the year. And it's calculated depending on how many days each month has. The credit to the buyer is going to be $2,500 divided by 365 days times 180 days, which is $1,232.88. Again, a credit to us as the buyer, a debit to the seller. And what usually you'll see on a closing statement is a per diem cost or per day charge. That's very simply calculated $2,500 for the year to 365, $6.85 a day. That number is calculated almost all the time because, lo and behold, closings don't always take place on the day they're supposed to take place. And if you have a mortgage on the property, the lender charges this per diem charge if it doesn't close timely. You'll also see a per diem charge on addendums from either short sale, not short sales so much, but always from REOs, where they'll say if you don't close timely, there's a per diem charge of $50 or $100 per day. Now, if it's the fault of the seller, as in an REO transaction, they can't close because of title issues, you shouldn't have to pay the per diem charge. I'm just telling you ahead of time. Now we're moving down to the summary, this bottom of the first page. The total paid by the borrower, okay, that's me, the buyer. I get a credit for the taxes. So I owe $39,846, which is purchase price plus my closing cost, but I get to subtract that $2,112 that I got as a credit for the taxes. What I'm going to bring to closing is $37,733.70. Now let's look at the seller side. Now remember, this is a short sale. Okay, the total reduction to the seller turns out to be what it says here, zero. Gross amount due to seller, $39,000 less the reduction. This is the seller. This is the homeowner. So this is a neutral transaction for him. He gets nothing. I have to bring in $37,000. He walks away with nothing, which is a standard clause in most short sale transactions for the lender to give the approval letter. However, if in fact there's a cash for keys program or something else, this number here will reflect $8,500, $3,500, or in one case we got $48,500 for a seller to walk away in a keys for cash program. Now we're going to go to page 2, and this is the top part of it. And this is the part where all eyes go right here. If you're a real estate agent, here's your commission, $39,000 times 3%, in this case, $1,170. It's paid from the seller's side. The numbers that I'm going to show you that are coming up for the cost, you have to bear one thing in mind. The lender in this transaction originally was sent a net sheet. This is a net sheet. It's a balance sheet that shows what they're going to net when they walk away. It's usually a HUD-1, but on the West Coast it's simpler. As I said, it can be a one-sheet statement. Bottom line is, what is the seller going to get? Now, on the other page, we owed them $34,000 and change as the payoff on the mortgage. Well, what happened to the rest of the money between $34,000 and the $39,000 that I paid for the property? Well, here's part of it. The $1,170 went to the listing agent who got 3% on this transaction. This property that's purchased here as a fourplex will be resold. How do I know that? It's already been resold for a $30,000 profit. An agent here made $1,170. Well, it's not bad, but it's not all that good either. At any rate, there's the $1,170. Now, if in fact you were getting a loan, all of these items, okay, could have been paid outside of closing. POC means paid outside of closing. If you do a deposit, for example, and the deposit isn't held by the closing agent, which is not uncommon, you may say to yourself, well, you can't do that. You don't know what you can do until you do it. I've been doing it for 38 years. If you ask, you will probably receive, if you ask enough especially. So POC means paid outside of closing. There's no loan here, so there are no loan fees in there. Now here we get into the second part. So items required by the lender to be paid in advance, there are none here, but for example, if you're closing on your home, you might have to prepay your insurance on your property, perhaps for a whole year. So that would be in here, and you may have to prepay some other things the lender requires. But at any rate, here's a reserve for hazard insurance, mortgage, none of this. We're looking at cash transaction. These reserves that you have are straightforward, standard. You can see exactly how much they're going to be. No negotiation power in this area whatsoever. Now let's get down into what's important, title charges. There's a settlement or closing fee to begin with, and there's one for the buyer and one for the seller. Now, as you can see here, my closing fee on this side was $450. Seller side was $550. Is that a good amount or is that a normal? What is that? It's what the closing agent charged on this particular transaction. He also charged $250 for the abstract of title. Now, what I want you to understand is, remember, seller's lender has to net $34,000 and change. So on this side of the equation, these expenses have to come out to the exact amount that's needed to make that number become net. And I'll show you on the next slide exactly where the rest of it came out. So, are these good numbers? Yeah, these are fine. One thing that's missing here is the document prep fee. Now, why is it missing? Because if he had charged me a doc prep fee, which he didn't need to because I didn't have a mortgage and this stuff is pretty standard, I would have had to bring more money in. Okay? I would have had another debit. Instead of $840 for closing costs, I would have had another $200 or $300. The other thing that doc prep fee is negotiable. The other thing that's negotiable is the title examination fee. See this, $1103? Whoever's issuing this title, they're issuing the title. There's no examination involved. At least you can have that reduced. The doc prep fee you can have reduced. You can ask about the settlement charges or closing charges. And the abstract or title search is probably accurate. This is about what it costs in our area. Now, having said that, I'm looking at another closing statement, which I didn't put up here because of the price of the property and where it is and everything else. This would jump out at everybody. But on the second page, I noticed that the attorney, the settlement or closing fee, charged the seller $1,200. Where you see $550 here, charged $1,200. I've seen other closing companies, agents, and attorneys charge as much as $1,700 or $1,800 to the buyer. Just way out of line. They're negotiable. Okay. When you get to the closing table, everybody's been there for a while trying to get there, and they want to close. So that's the most negotiable time you're going to get for the closing agent if you can do something. There's also on this closing statement an endorsement, and I have no idea what it refers to, but it's $564. So I don't know what that endorsement means. I've never seen that before. These are junk fees. This is the title insurance. This is the title policy, $224.25. That's on $39,000. Now, there would be an owner's title policy and a lender's title policy if there was a lender on this, but just paid cash for the property, so there's not an additional fee. Let me see what I have here. There's the $224.25. I'm going to show you how that was actually calculated because this is another place you might be able to save some money. Title insurance is generally charged by what's called a promulgated rate. The promulgated rate is the minimum rate the state will allow closing agent or attorney to charge. The title insurance policy, 70% of that, in some cases 80% of that, goes to the closing agent. The title company only gets 20% of that money. Now they can charge other fees like the title search and abstract and stuff like that, but they only get 20% of that fee. So for $100,000, the amount is $575. That's a half of 1% roughly. But you can see it here, 0.00575, which is a half of 1%. So it's a sliding scale, and it decreases the amount of the purchase increases the purchase price. So actually what I have in front of me, the purchase price of this property I told you about, the HUD, is over $1 million, right at $1 million, $1.1 million to make it exact. And the amount of the title insurance is $5,390, which is about exactly what I calculated here. This is not half a percent, 0.575%. If it was, it would be $575. So don't worry about it. We're talking about $400 difference on $1 million purchase. It shouldn't be your problem. So in the above example where I'm buying the property, this fourplex for $39,000, I calculated the rate as $224.25, which is exactly the amount that I showed you before. This number is not negotiable. You cannot negotiate the promulgated rate. I'm going to say to you that this rate is what you should see, but the reality is I've seen it be 2 or 3 times this much. There's no limit to how much the closing agent can charge on the upside. There's a limit on the downside, but he can get away with murder if you don't know any better. So the idea here is make sure you're paying the lowest rate when you go in. So far we've hit about at least four or five places where you can negotiate. So here's the next portion of the HUD statement. What we have here is this is simply a recording fee for the new deed that's going up, any other documents that might be there, doc stamps for recording, the lien search. Now, here's what I wanted to show you. Typically, a lien search is going to be $295 to pick a number. What you can see here is the closing agent has charged me $93.49 and the seller $201.51. So why did he do that? Well, remember I said to you he has to knock the $39,000 down to $34,000. So as much as he can get on the seller side, that saves me money. On my side, I got a courier fee and a wire fee. But these charges, anything below line 1300, are supposed to be able to be documented in written proof by the closing agent. And you'll see some really bizarre charges in here. For example, notary fee. I went to a closing last year. One of our students had the property. I guess I was funding it or something, but I went to the closing. And I called beforehand to get the HUD statement. And I noticed on the HUD statement there was a $250 notary fee. So I called him back and I said, what is this for? He said, well, that's what we charge for our notary. I said, to notarize the deed and the mortgage. He said, yeah. I said, okay, I'll bring my notary seal and I'll notarize it myself. I could bring somebody in the office as a notary and save $250. So they took it off, but it was just a junk fee. You need to look and see, ask. If you have any question about it, ask. Now this is the bottom line of the second page of the HUD statement. Basically it's signed by the buyer and the seller, dated, and it's signed by the closing agent also. Here's a very, very important one. When you're buying REOs, most of the time they want their closing agent to handle the transaction. That's not because they trust him any more than they trust any other closing agent. It's because, in general, that law firm was involved in the actual foreclosure of the property. And when they did that closure way back when they started it, they didn't get paid very much. Their deal was, when we sell the property, you can do the closing. That's where the money is anyway. It's not in the title search that they were doing when they first went into foreclosure on it. They're going to say to you, use our title agent, there's no question whatsoever, you have to do it, and sometimes you will have to do it. Fannie Mae, for example, allows you to pick the closing agent if you pay for the title work. And the title work is not just the policy, it can be the abstract, it can be the title search, it can be a number of things. You need to know what the closing agent deems to be the title charges. What you have him do is put as much as you can on the seller side, if it's not a sale where you have a net sheet, and then see what they won't take. They'll come back and, ironically, 99% of the time they don't argue. They don't care on an REO about the net as far as the short sale loss mitigation reps do. Those guys are meticulous about, okay, you gave me this net sheet. Here's one of the big issues that we see all the time. There's a water bill out there, but it's not a lien. In the good old days, probably 5 years or so ago, the water departments would simply, when you didn't pay your bill, they'd lien the property. You couldn't sell it without paying off the lien. The title companies, and there's one title company for one of the major banks that does not do a lien search at all. And they will tell you that we don't do a lien search. How can you do a closing and get a title, a clear title, and not do a lien search? You can't. They tell you, we're not giving you a clear title or a marketable title. We're giving you an insurable title. And in the section B1, the clauses of the title policy, the title commitment, which later becomes the title policy, it says in there basically that this title policy covers everything that's in the public record. If it's not in the public record, they're not responsible for it. So if they don't do a lien and send ask for lien letters from the city, they may not find out about things like the water bill and code violations that haven't been posted into the public record. And you can be in for a real shocker. The worst we've seen on water bills personally is about $4,300, but again, we know to look for it. As soon as we put a property under contract, we call and find out what the water bill is. And sometimes the lovely people at the water department will say, we can't give out that information because we have to see a HUD closing statement. Oh my gosh, that's silly. But press them or go to a supervisor and get the water bill. Now, is the water bill negotiable? Most people would say to you, absolutely not. But the one that we had for $4,300, we negotiated down to, I think, I'm going to say about $400. But we wound up making the seller pay for it besides. If you bring this stuff out before the closing, you're not going to have to pay it. You can have them pay it. And it tells you in the addendums, they'll tell you in the approval letter, we do not pay for any of this stuff. But that's not necessarily true. I guarantee if you don't ask them, it's true. If you ask them, you've got a good chance of getting something out of them. So here we are with these new numbers, which are the final tallies. And again, here's line 1400. You'll notice that it's 846. Buyer, that's me. That's my closing cost. And here's closing costs, which are $2,444. So here's what I'm going to talk about a net sheet for a minute, because this is very, very important. It's simply a HUD-1 closing statement in most cases that's used by a loss mitigation rep on a short sale transaction, so that he knows when the closing comes exactly how much money he's going to net out of the transaction. In some cases, they have tiers of discounts that they give. You wouldn't know this by the silliness you get into negotiation on these short sales with, but literally the lower the price that the loss mitigation rep agrees to, the lower his commission, so to speak, his payout, his bonus, based on that particular transaction. And they go by percentages. They don't go by tiers as such, but percentages are pretty much levels. At any rate, he needs to determine what his bottom line proceeds are before he goes to the closing. They don't like surprises any more than we do going to closings. We like to surprise them. But at any rate, the problem in making a net sheet is that you need to do a lien search to find out all the outstanding liens, the code violations, utility problems, and accrued taxes, and so on. I guess up until about 2 years or so, students would come to me and say, a call from the realtor who has the listing on the short sale, and he said, I need a net sheet. Do you know what that is? And I'd say, sure, not a problem. And I'd pull up a program to generate a HUD-1 closing statement. I did that for, I don't know, a couple of months, and I found out what I was doing is the title work on the property to make sure I was pretty close to the number. Because if I was wrong, then the buyer of the property had to pay that whatever I was wrong. Not so much accrued taxes, but outstanding liens and code violations and things like that. So it's very important that these liens are accurate. Now, if you go to a closing agent who you don't know, when you say to them, I need a HUD-1 closing statement for this property, oftentimes they'll say to you, we don't pull that until we have to. It costs them money, at least costs them time. I don't know how much money it costs them. It depends on how they do their closings. Some closing agents are not charged for the title work if they don't close on the property. So in other words, they can pull the title work. It's not what's called certified, but it's the same title work that will be certified if in fact it's pulled again and they pay for it. So they pull the title work and then you don't close. What happens? Well, theoretically they have a cost, but in most cases, most closing agents do not have a cost. But attorneys will come back and they will say, you didn't close, therefore therefore I'm going to charge you for my fees and expenses, which in some cases they'll charge you for the title work. If a realtor asks you for a net sheet, remember this, if a realtor says to you, I need a net sheet from you for the loss mitigation rep, you have a problem. You need to get another agent on that case or get somebody who knows what they're doing, because a good negotiator knows that he has to submit or she has to submit a net sheet or a HUD-1 closing statement from the beginning. Now what's going to change? How can you make up a HUD-1 closing statement if you don't know when it's going to close? Well, the only thing that's going to change is accruals, like taxes, HOA fees, and some other things like that. That the loss mitigation rep will understand. They will not understand major changes. So you should not be doing a net sheet. And if you have an agent that's doing it, you have somebody that doesn't know what they're doing in terms of negotiating. They should have this under control beforehand. So what have we learned? Review your HUD closing statement before you go to closing to catch errors and ask for a discount on some of these line items. Now, I've said that I'd like you to see your closing statement 72 hours before the closing. One of my students said to some of the closing agents he was dealing with, Dave Dinkle said that you have to, by law, give me the closing statement 72 hours. I didn't say that. There's no law that says you're going to get it 72 hours, 48, or 24 beforehand. In the good old high-flying days when anybody could get a mortgage, my dog could get one, those closing statements were never generated literally until after you sat down at the closing and sometimes an hour or two later. The reason being is the lender on the other side, for the conventional buyer that you were dealing with, changed the terms, reviewed the document. There's one small mistake. In 40 pages of documents, they would go back and generate not the single page. Oftentimes they generate the whole document over to make sure it was okay, because one field may be related to another field. And if you don't do it correctly, for example, the APR on the loan is 6.2, and it comes out to be 6.3, you have a major federal violation. That's why some of these closings with conventional buyers take so long. They have to be perfect, or the lender's set up for huge fines. So, look for accuracy. About 60% of HUD statements contain errors. What kind of errors? Well, I showed you one on the address, but more importantly, anything you can think of can be an error on there. The commission, accrued taxes, the promulgated rate that we're supposed to be charged, just check it. Now, there's this old saying, how do pygmies eat an elephant? It's one bite at a time. Don't get bewildered by these HUD statements. When I said I was going to talk about HUD statements, a number of people called me and said, I'm really glad because they're very confusing. You have to take it line item by line item and think about what you're doing, whether you're the buyer or seller, and that's all the charges you care about. Don't worry about the opposite side. They're going to pay the least they can or the most they can. It's up to you to get the charges either reduced or shifted to the other side. Okay? If you're going to ask for a discount on any line items, just remember the closing agent needs to make some money or he won't stay in business. Frankly, my personal experience has been I don't care that much about the charges. Now, that's not stupid, and I don't care about money, but I realize that the guys have to make a living. And if I weasel them to death on an extra $50 or $100, the likelihood of them saying something to me like, Dave, what you ought to have is another document here just to cover yourself, they're not going to say anything. All they care about is covering themselves. I went to a closing years ago, and it's the first time the closing agent had ever seen a land trust. He prepared the documents, and he brought them out, and I was reading through them. And I said to him, whoa, this is a pretty interesting document. Where did you get this? He said, it up. I said, well, not only did you get up, but it has nothing to do with the transaction. He said, you're right. It's to cover your ass. Very simply, that's to cover me because I don't know everything about land trusts, frankly. So that's what it was, a disclosure. Basically, it didn't say he didn't know everything about land trusts. It said if there's anything wrong with it, he has no responsibility because he didn't draft it, didn't read it, doesn't care about it in effect. So you're going to get some strange documents sometimes, but as a seller, you have very few documents. As a buyer, that's where you either make or break your deal. So read what you're getting. If you're getting a mortgage, you can take your time reading the mortgage documents. You can't change them. However, if you're a cash buyer, look at what you're getting into, especially on the title commitment and especially under Section B1s. I say this every time I talk about closings. At the closing table, before you leave, you ask the closing agent to delete the B1s. And what that means is you no longer have a title commitment. You have a scratch title policy that is valid as long as the deed's recorded. Okay. Typically what happens is the deed's recorded, those scratch outs on the B1 that I'm talking about them doing now are done after that, and a new title policy is issued. Prior to that, it's a title commitment. So if you're going to flip the property or you want to know that you have all of these contingencies that you don't want to know about or you want to have solved, now's the time to do it at closing. And again, delete the B1s is how you tell them to do it. And the bottom line as far as costs are, it doesn't matter unless your deal is too skinny. If you're finding that you're making $1,500 or $1,000 or $2,000 on a deal, you've got to reconsider how you're getting your leads and what you're doing because they're just too small. Okay. So very quickly, coming next week, I'm going to talk about short sales versus REOs, which is better. And I'm going to go into details about so there's been some major changes even in the last week or so on REOs, and I want to go into some of those things so you guys can be prepared. And which is better, let's say, what does better mean? Ease of getting them, profitability, how many of them there are, things like that, and what's coming. Now, I'll mention this to you guys that are on the phone now. I went to a mastermind group of realtors in another county north of us. And the speaker was the coordinator for all the short sales in, 5-county area, which is the largest concentration of people in the state. And he said that his bank is doing about 600 short sales a month. Next year, they'll be doing 900 a month. Year after that, 1,200 or more. Year after that, they could be up to 2,000. So when you hear about there's no deals, everything's being sold instantly, there's still an enormous market of people that are upside down that aren't going to get out of that unless they do a short sale, and they're not making their mortgage payments. So there's always going to be inventory. And if you're concerned about, well, there's an international buyer coming in and he's buying 1,200 homes, great. In the county north of us, there's 30,000 homes in the court system right now for foreclosure. Our county, there's 36,000 that have had the list pendants delivered, and south of us, I don't know what's in that county, but there's probably about 25,000. So let him buy the 1,200 and get it over with, because there's still many more coming. And if you have a problem getting REO deals or short sales, don't forget about motivated sellers. Traditionally, REOs and short sales were a small amount of what we did in the marketplace. It's only been the last 2.5 or 3 years where they've become, well, REOs are still about 28% of the deals we're doing. Short sales are up to about 33%. So let's call it 50% of our deals are short sales and REOs. But I'll talk about those in depth next week. I'm going to pull this over first. I hope you can see this. This first statement, it's so frustrating dealing with buyers like you. It is a complete waste of time for all parties involved. This is a statement made by a realtor to one of our students. He sent it over to me. He had put in an offer on a contract which he was told was ridiculous and insulting and the usual stuff. And then, of course, later, when the agent couldn't get the buyer that they had to close, and I'll say it's she, okay, it's not he, it's she. Well, they came back to him and he made an offer and they were all set to accept, and he said, you wanted me to go out and see it. Now I went out and see it, and now I need a discount because of these reasons. And this was her response. It's so frustrating dealing with buyers like you. This is bravo. Okay, this is good. These are the kind of responses that I'd like to hear, rather than it's so easy dealing with buyers like you because you don't know how much you're paying for the property and you overpay. They won't say that to you, but that's what they're smiling about all the time. Okay, here is a question. If the agent has on the MLS that the bank has approved the short sale for a price too high, can you still make an offer lower than the approval price from the bank? Of course, absolutely. There was a time, and I'm going to say it was 6 months or so, maybe it was a year ago, but typically on the MLS it would say short sale approved, and you'd go in and they'd say, well, the short sale was approved by the bank for a short sale, but it hasn't been approved for a specific price. The board of realtors came along and said, that's kind of misleading because in some cases the bank didn't even approve a short sale. So now if you say short sale approved, it means you actually have a price to go by. That should be the listing price. Just because it's a listing price doesn't mean anything. I don't know if I said this in one of the other webinars, but there's a definite move on between, well, I'm going to say Fannie Mae. Fannie Mae hates me, but they love me. I don't know what they do, but Fannie Mae, I don't know if they started or they're following in line, but what we're seeing is on the BPOs they get on properties that they're selling, they used to take the lower of the BPO or the appraisal, multiply it times a factor of less than 100%, and put it out as the listing price and go from there. They've since increased that in the past 6 months. They're now up to, last I heard, 117% of the higher of the BPO or the appraisal price. Now, the idea being that investors are the only buyers. There's a lot of them coming in the market, and the majority of them don't know any better about what's a good value. So what we're seeing is we're seeing properties listed at full market price that need not even tens of thousands, $50,000, $60,000 in repairs. So somebody coming in to buy that, let's say it's $128,000 is one I remember. The neighborhood is a $100,000 neighborhood on a very good day. It needed about $40,000 in repairs. So you go in there, you have $168,000, and what do you think you're going to do with it? You think there's a bigger fool that comes along and buys that? Well, if there is, great. He has to be a cash buyer because he's never going to get a loan that's twice what the neighborhood is bringing almost. So should you? Yes. Make your offer that makes sense to you based on what exit strategy you want to have. Whether you're wholesaling it, you're going to keep it as a rental, or in fact you're going to rehab it and flip it. Next question here is, I've been searching for property with equity in it and has been on the market for 4 months, but when I look on the IDX it shows they're trying to do a short sale. Is it possible to do a short sale if the property has equity is what it looks like? Okay, so let's get down to basics on what a short sale is all about. Let's say that I just showed you on the property that I bought for $39,000. The original judgment amount was $309,000, I think. On a short sale, let's look at that. That was not an REO, that was a short sale that I bought. So that wasn't a judgment amount, that was the final amount due. REO, it's the judgment amount, but nonetheless, owed $309,000. We negotiated $39,000 as the payoff. Okay, so let's assume, for sake of brevity, that that property was worth $450,000. Okay, so I go to the lender and I say, "Hi, my name is Dave Dinkle. I'm trying to negotiate a sale for my homeowner, or landlord in this case. They don't like investors, so they aren't very negotiable for investors. But you can get great deals on multifamilies and short sales." Yes, and Mr. Loss Mitigation Rep, I'd like you to reduce the mortgage to $250,000. Well, what he does instantly, he goes and gets an appraisal or a BPO, generally a BPO first, and he notices the property's worth $450,000. The chances of him thinking about a short sale are over within a millisecond. If it has equity in the property, it's out of his hands. It's going into foreclosure. Okay? There's no chance they're going to do a short sale on something that has equity. Now, if you say to me, "I searched for equity in properties and I came up with short sales that have equity," likelihood is they have a second loan or an equity line that's not shown correctly in the public record. So they're still upside down, because banks aren't fools. They were smart enough to lend people money they couldn't afford to pay back, and now they're collecting it twofold. But the reality is they're not going to give someone a short sale. You can never say never. But if you're going out looking for deals, don't look for deals with equity in them, hoping to do a short sale on them. Okay? Something I want to mention to you that's very important. As a short sale negotiator, a dichotomy between us as investors and the short sale negotiator. The short sale negotiator may work for an attorney, or he may work for commissions only, or some combination thereof. He works for somewhere between 2 months and 10 months to get that short sale approved by the lender. Once he gets it approved, as investors, we want to try and get a better price. But let's say that the property is a $100,000 property. We've offered $60,000. Lender comes back and says $80,000. All in that time, and this is all going on, it's been listed for $85,000. We have a decision to make. We either have to take the $85,000 or pass on it. Now, the short sale negotiator, if they're really working for us and on our side, we're going to go back and push the loss mitigation rep to reduce the price. Hopefully they'll come down to something like $70,000. It's not a big decision. Remember this, that listing agent is getting calls on that property listed for $85,000 from other investors who are willing to pay that much because they either don't know any better, they want to rehab it, think they can create equity, and it might be a great deal at $85,000. So if you say, "I'm not doing it," what is the listing agent negotiator supposed to do? Can't turn it back. What she has to do is run out to some of these backup contracts, in effect, and say, "Guys, you were thinking about $85,000. My deal fell through. Are you still good for $85,000?" and follow up. And frankly, they deserve to do that. But now it becomes a fine between how hard do they work and how hard do they just work to get the deal done so they can sell it to somebody else. Our experience has been mixed. What it means is for us, we don't do any short sales negotiations ourselves. We have listing agents that do the negotiation. We rotate them out. They do well. Sometimes they don't do well. We have to try them. We have to make money on every deal. I was thinking to myself, if you're an agent, if I'm talking to you as a realtor, and I said to you, "Mr. or Mrs. Realtor, I have a deal for you. I'm going to give you $1 million, and I want you to go out and buy properties. Now, you don't get any commission on it. I want you to use that money to make money in the real estate market. So you go out and buy whatever you want. In a month or two, bring me the money back, show me how much you've made, and I'll give you half the profit." I guarantee you that the mindset of the realtor would change very, very quickly. Instead of paying full list price or higher, they would start negotiating just as investors do. And if they weren't paid the commission for buying the property, they'd have a whole nother mindset. Okay, guys, thanks very much. Looking forward to seeing you next week. If you want to send me questions to the address on the screen, blogdavedinkle@gmail.com, send them ahead of time. Chance I'll answer them, otherwise I'll bring them up at the next meeting. And thanks very, very much for attending.